So welcome back, everybody. I'm excited to announce, actually introduce our lunch keynote presenter, and somebody I actually look up to quite a bit and find interesting to talk to every single time we meet. Is Richard Williams. He's now the chairman of Bunker Hill, but he's also the ex-COO of Barrick Gold. He was the COO for 3 years under John Thornton, helped orchestrate the turnaround of Barrick back in the day. And but also he's got an interesting military background. That's why I think you were the COO, because you had to put some discipline into that bunch and really help them get their things sorted. But he's been the lieutenant colonel and commander also of the 22nd SAS, or Special Air Service in the UK. And it just shows a bit of discipline. And just when you hear him talk as well, I'm always fascinated. It's just a bit of different caliber of person and personality than you see usually in mining. That's why I'm really excited, Richard, that you're joining us here on stage and to share some of your knowledge and your background with us. Thanks so much for coming, and thanks very much for joining us here for this presentation.
Thank you. How do we turn the button?
Just right there. And then.
Thank you very much for attending. It's a lunchtime slot, and I'm going to try my hardest to keep everybody interested. Okay. If you start falling asleep, I'll notice. Anyway, on the assumption that people can hear me, I just want to talk a little bit about Barrick Gold and my job there. Because it's been a bit of a transition between being part of a large turnaround company, or turnaround in a large company, and then taking on a small asset, which was also a turnaround objective. But just to give you a feel for things, Barrick lost, as you can see, greater than 300% of its value when gold price came down from 2013. And unfortunately, as was mentioned by one of my shareholders yesterday in his brilliant talk, David Finch, they just bought a copper business for many billions of dollars, and they'd funded it from debt. So at the very moment at which their top line was collapsing, they had more debt than they would probably have liked to have taken on. And at that particular moment, Peter Monk recruited John Thornton, former chief operating officer of Goldman Sachs and a global businessman, not a miner, to come in and take over the gold business, with a view that over time that business would grow globally, particularly with respect to its relationships with China. John, hired me in to assist in the inevitable restructuring that had to happen within the company when costs and structures weren't aligned to what the balance sheet could support. In other words, we had to cut costs and cut people and rearrange systems very quickly. I started off doing that as his chief of staff, and then after a year, then got appointed to be chief operating officer. I'm not a mining engineer, I'm not a geologist, I'm not a metallurgist. I had previously run exploration businesses, but I'd never been in an operation of this size. And the situation beyond having a collapse in the gold price is the cost structure, as David Finch had outlined yesterday, had followed the gold price. So the actual margin, although they were growing as a company, the actual operating margin had stayed pretty much the same. And we ended up, when one took over in 2014 or so, the task with an all-in sustaining cost that was around about $960 an ounce. And by 2016, one had got that down on a smaller portfolio to $730 an ounce. There were within Barrick's portfolio a number of world-class assets, particularly with Cortez open pit, which we were mining at 1.4 million tons a year at 5.5 grams a ton. And the cost per ton was around about $1.4 a ton, and you can work out the maths on that, bearing in mind most of that ore went to a heap leach. Hugely significant assets like that. And we had some really excellent people. But even excellent people, in the face of the need to change, don't always want to change. I'll come on to that point later. We had the new chairman. We had a very disciplined vision, which David Finch articulated better than I will be able to do now, associated with only putting money into that which would make money and only spending money on that which was absolutely essential. We had challenging partnerships. Over our time, we ended up in a large dispute with the Tanzanian government, but that is only but one of many other challenging partnerships that large companies often have globally. And where I really came in, we had, as often happens with large companies, a reasonably top-heavy structure where a lot of decisions were made centrally, even though most of the real action and the real risk needs to be managed down on the sites. So what you see is two charts, one showing the collapse in value that we wanted to change, and you can see how we came back up again in 2016. And on the right here, which I'll move down towards, is quite important when you look at the gold price. But we had, at the time one took over, a cash flow break-even price of around about $1,500. That meant gold had to be at $1,500 for us to make $1 net of our investments, net of debt repayment, and so on. And our target was to get it down to $1,000 cash flow break-even so that we could maintain a margin over that period of time. And for that, what that required us to do was to remove all of the regional offices. So we got rid of Santiago, which is the South American office. We got rid of Salt Lake City in North America, and we got rid of Perth. We had all the operations report directly into the center, the chief operating officer, me, who managed, as chief operating officers do, the risk and performance of all of those operations through the right people on the ground. We changed 100% of the mine leadership, not because the existing mine leadership were bad, they were all excellent, but we changed them for people that were prepared to change. And one of those particular people that were prepared to change was a guy called Sam Ash, who is CEO of Bunker Hill. I'm the executive chairman. And he was then a 35-year-old mining engineer, American, whose father was a mechanical engineer who worked on Bunker Hill in the 1970s. And the chief operating officer who I took over from, a fantastic man called Jim Gowans, who'd been in the business forever and still is in the business, said, you've got to meet Sam Ash, because one day this guy is going to be CEO of Bunker Hill, he is, CEO of Barrick Gold. And so we appointed, unusually, a 35-year-old mining engineer to turn around one of Barrick's, well, it was at that time, the largest copper business in Barrick that was failing, losing millions of dollars every month. And he did. But we did that with every single one of our operations. And every single week, every single one of our operations would report into a central video conference that everybody in the company was able to dial into, that over an hour and a half would allow us to monitor performance and risk in ways that ensured the many crises we had and the many opportunities that we could see, we could collectively as a team manage successfully. So over that time, 4 years, we never missed a quarterly stretch production target, and we doubled the company's operating margin while gold price came flat. And it was a we. I didn't have a single technical idea. All I did was I built a system that allowed everybody who had technical brains and experience to talk together to solve problems. But what I did was take all the risk off them. Because a lot of people on the ground want to try something, but in a big company, if it doesn't work, they get sacked, which is a very intimidating environment to be experimental in. So I had to turn to people and say, if you believe in this, and the team that's advising me believe in this, I buy the risk off you. If it doesn't work, it's my decision. You're the right people, you know what you're doing, get on with it. And that's how the company doubled its operating margin. So from that, let us go to Bunker Hill. So that's a little bit of the big picture piece that you wanted me to do, Kai, and on the piece. Now, we left Bunker Hill, Sam, myself, and a few others, when John Thornton was able to buy Randgold Resources and its remarkable CEO and management team, Mark Bristow, and that team. So a number of us that had done this turnaround stepped down and looked for other things. Sam, by this point, was on London Business School doing an MBA, and we looked around the world for a project that would be very long life, that would, over that life, allow us to operate in the lowest quartile of the cost curve and be in a tier 1 jurisdiction whose risk we understood. And do all of that without having to depend upon wizard new technology. Because I love wizard new technology, but it's very risky. Now, those assets only exist if they're distressed. And Bunker Hill, when we found it, was very distressed. It shut in 1980 because of environmental mismanagement and it remained closed ever since. 5-6 years ago, it got grabbed hold of by a management team that did a scandalous pump and dump scheme, were fined and banned by the SEC. So Bunker Hill had a toxic reputation in the market. Some of us lost money at that time. It was a very difficult time. And the company didn't even own the asset. It had an option to buy it in terms that were just egregious, and it owed the United States Environmental Protection Agency $20 million for unpaid water treatment. That's what you call distressed. Oh, it didn't have a 43-101. There were no official resources. Perfect. It was cheap, and if we could turn it round, it would become valuable. Now, why was it valuable? This mine, along with its smelter, got bought in 1968 by Gulf Resources for $1 billion on the US stock exchange in 1968. Unfortunately for that company, in 1969, the United States passed the Environmental Protection Act, which is a good thing for the environment and for mining, but the smelter that this operation had couldn't meet those standards, along with the Clean Air Act in 1972, Clean Water Act in 1974, and the Superfund Act in 1980, and it got shut down. But the metal was still in the ground, and we inherited 12 million tons of resources. Reserves in the old classification, but nothing in terms of 43-101. The mine was flooded up to a certain level, but we had 100 years worth of data on site. So we looked at this, so this is where I'm going to come into this particular chart, which connects to David Finch's charts yesterday. You know the Lasagne Curve. You know there's two bits at which money can be made as an investor. Not guaranteed, but there's certainly the area that people most like. One of which is in the pre-production stage. And so if we can bring Bunker Hill into production rapidly, we, currently valued at 23 cents and around about $35 million US, should be re-rated on an EBITDA that, again, it'll be coming out in official documentation because we're going to be issuing a PFS at a reasonable level. Should be many multiples of that when we get to this point. But we've also secured an exploration option in Colorado, which is a pure exploration option. Again, another closed mine site with 3,000 hectares and 2 other mine sites on it that we can explore. So what we intend to do is to do a low capex restart, that's sub $60 million, to be back into production at the end of next year, and then use that cash flow to pay down that water bill that our predecessors didn't pay. Over time, we negotiated with the EPA successfully a staged payment, which they've never done before, not in these circumstances. And then we're going to use that operating cash flow to increase value in the asset. Now, because we are asset optimization operators, and looking at all the operators in the room, of which there are a few here, you'll know that what you then do, getting hold of your asset, is see what opportunities you are for value creation, which typically cost money. Resource expansion is drilling, ore sorting. Again, there are systems and techniques and whatnot you've got to put in there. Process optimization, in-house water treatment, conveyor haulage, there's a whole bunch of stuff. So whatever we're starting off at this valuation, we intend to expand by reallocating that cash flow into the asset to expanding it. And so for the shareholder that gets into this business now, once we're into production, you're into a position where its expansion is funded from cash flow, not going back to the equity or the debt markets. So the most dilutive point is where we are now, getting to restart. And after that, as shareholders, you just own that slice of the action on the assumption that we can deliver. And you have to make your own mind up about that. So, regeneration. You'll see another slide on this, but I'm just going to give you the headline points. You see me there. You see Sam I've outlined. David Wiens, who's a young CFO, who some of you would have met, based out of Vancouver, which is 6 hours drive from the mine site. We spent a long time trying to find a CFO that could take on the challenges of a turnaround site. A site where no one had paid taxes for 10 years, where there was no process, there was nothing. It was as complicated and as challenging in a systems basis as well as it was as a capital market basis. He's doing a brilliant job. But the guy on the right there, Brad Barnett, I brought into Barrick to transform our closed site portfolio. Barrick has over 50 closed sites. Back in 2016, it was spending $160 million a year on ensuring those closed sites were compliant with their regulations. We're only spending $70 million on exploration. So I said to Brad, who's an environmental agricultural entrepreneur and who worked with the US government throughout South America and Africa, and I met him in Afghanistan doing the same thing, come into Barrick, and aside from negotiating the power line successfully that would connect Veladero with Argentina, in Chile to Argentina, which he did in a few weeks, along with a lot of lawyers and teams, go into the closed sites and have a look around and see whether we can reduce the holding cost and look for value. And where we can find value, if it's a mine, we'll sell it on to a junior, SK Creek or something. And when it isn't a mine, then what else can we do with the land, was what Tim Coughlin came up with yesterday. It's got power, it's got water, it's got people, it's got land. Well, we can turn them into farms. All of the ski resorts in the United States are built on old mine land. Why? Because it's private land and it's easy to permit. Bunker Hill, we've got an intact permit and we're on private land and it's fully patented. We don't have to wait 15, 20 years to get a permit. We already have it today. The same with non-mining businesses. So Brad was very key to dealing with the EPA and making sure that all of that renegotiation happened. I'm going to spin through some things. You might come back. So when we look at our regeneration pipeline, we're looking across the whole of North America and into Canada through the thousands of closed sites that exist, in partnership with a little group down here called Mine Water, who their business is turning dirty mine water into clean mine water and selling it, it's a scarce resource in North America, into the cities and towns. And as a result of that, they end up with all this mining territory. And so we've done a joint venture with Mine Water in Colorado over a mine that shut in 1942, mining 29 grams a ton over reasonable widths, called the London Mine. And it shut in 1942 because of the War Act. If you weren't mining something essential for the war, you were sent to the Pacific or Europe. And when they came back, it didn't work. So that's been basically in abeyance, owned by Molson Lager, weirdly, for a while. But now we have hold of that and 2 other properties. And we have a series of business development opportunities in this area where we're turning closed sites that are of no value into mines. And we're only picking those where there is either an existing permit or something we can get permitted within 2 years. I've kind of given you the Bunker Hill history. One point on the geography here and the specifics. You will note when you have a close look at Bunker Hill that the resources that were left to us are primarily zinc. But in its history, it's a zinc, lead, silver mine. It produced 165 million ounces of silver, and 50% of its revenue came from silver, and 50% came from base, like zinc and lead. The particular ore block, if we call it that, the Quill and the Newgard that we were left, the 12 million tons, not all of it, but the majority of it's from that is a zinc-heavy ore body. So our initial operations are going to be focused on making money out of that base metal ore body. But there's a second depositional event. You can see it on the left there. The blue is the zinc-heavy sphaerolite, and the red is basically the galena. Much more narrow. It's a second depositional event, which is high-grade silver, which gets relative to the surface, it's not quite this way, higher grade as you go deeper. And so it's, as a result over time of mining both the zinc-heavy and the silver-heavy, the mix gave you that 50-50 mix. Now it's around 70-30. Our intention is to get it back to 50-50 again over time through exploration and through accessing the deeper area. What you see along there, it's very shallow, Bunker Hill, relative to the others. Crescent Mine, which is in care and maintenance. Sunshine, owned by Tom Kaplan. Consolidated doesn't exist anymore. CDA, Kerr, and Galena is both owned by USA Silver. There's an interesting consolidation opportunity there for somebody. Might be us. You then have, I'm not going to go through the importance of the metals. You all know that. Our restart plan. Look, we did a PEA initially, and you'll all know from your experience and what you were told yesterday, PEA level of engineering is not good enough to restart a mine. So you won't be surprised on the basis of all of this, and you can see a very low capex number at the front end there, that we're going to be issuing a PFS for the restart of the mine. And our engineering level is well beyond PFS, and we're making a decision based on proper engineering, not just what this is giving us at the moment. This also doesn't include upgrades to the resource model that we've been doing over time. And so when we issue our new data, you'll see that the improvements. But that $25 million worth of free cash, if you look at the time here, is really important. If we're able to generate, in our view, starting off at $25 million worth of free cash and reallocate that to all of those unlocking value projects that we told you about, be it London Mine or elsewhere, the value proposition is exceedingly exciting, and we don't have to go back to shareholders to do it. The way in which we're going to be focused at starting the mine, because what you see here is basically the blocks in that resource model. And that's kind of the Quill and the New Guard going down here. And these little areas down deep, this is where the water level is. They're a series of galena veins, mainly, nicely high grade, typically named after Second World War generals, such as the way the mine was, so MacArthur and Ike and all the rest of that. And there's a small area up here in the UTZ. We're going to be mining the bit above the water early to generate that early cash flow while we dewater and gain access to the bottom area. So the part of the project that will be defined by the PFS will be in this upper area of the mine. It's a restart project. We're not going to dewater and drill and triple our resources and make the maximum MPV and issue that as that's going to take 3 or 4 years, and it'll be a waste of money. What we're going to do is we're going to make money and then develop the mine. So people need, when they look at the investment proposition, they need to benchmark it against other restart projects, not against some of the other very, very good projects that you've heard about here, who end up with an MPV of sort of $400 or $500 million, but a $300 million capex number. We're interested in a low capex restart. Capital is really precious to us, and cash is really exceedingly important. So for that, because we're all facing inflationary pressures, we bought ourselves a second-hand plant from Teck 140 miles away. And we sold, we bought it for shares. $2.5 million US dollars of shares and $500,000 US dollars of cash gave us exactly the right processing plant for what we need. 1,500 to 2,000 tons a day operation, 140 miles away. And we're going to be moving it from Washington State down the federal highway, and it's going to go into this building here that exists. The primary crusher will go underground, but everything else will go into that existing building. That existing building used to hold a small processing plant and various other things, but that's essentially how we've got ahead of the capital inflation curve and how we're able to move so quickly. Otherwise, because if we were ordering that type of plant right now, the inflation costs would be enormous and it wouldn't be delivered for a couple of years. We're developing underground now with the money that we've got to link all of that upper area for rubber-tired equipment, with the primary mining method being transverse long-hole stoping. So it's low-cost bulk method over ore bodies that are 150 to 200 foot wide. You'll see all that coming out in the PEA. And the great thing about starting that type of work right now is it allows us to understand precisely what the costs per foot are and then factor all of that into our models. Because in terms of financing the restart, we took a stream from the new Sprott streaming and royalty business. And before we can draw on that, they and we need to be 100% content with the capex plan. Obviously, this helps us. This is not theory anymore. It's not a 30% or 40% engineering. It's actually how much does it cost to move a ton of earth? In water treatment, I mentioned that the EPA hadn't been paid water bills prior to us. Obviously, we pay our water bills because coming out of the mine is acid mine drainage with a lot of metal and so on and so forth. We've got an existing water treatment plant, but they charge us $2.5 million a year for the privilege. We're building a new water treatment plant at the moment, and we've got the discharge permits and all of that for this. Our water expert, our partner, Mine Water, is doing this, and this will cost us 10% of what the EPA is going to cost us. And we had the governor and the head of the EPA looking at this with me 2 weeks ago on the mine site. These are little things, but when you're looking at cost and profit margin and everything else, I want the water to be absolutely clean. And if you go onto our website right now, you can see it uploads every couple of minutes what the quality of the water is that's leaving the mine site now, fully transparent. Don't want to have any problem with the environment, but I don't want to be paying $1 more for it than I have to. Clearly, we're doing a lot of work at the moment to make sure all the The area is ready to receive the plant. For those of you, if you manage to get across to the Denver Gold Show or Beaver Creek, you're all welcome to come and visit the site in September, and we'll have all the plant facility already there by then, and would have finished that underground work, and you can come and have a look at it moving forward. As I said, we got a financing package with Sprott. It's non-dilutive as long as they don't convert their debenture into shares. But anyway, it's not a wholly inaccurate statement at the top there. But it was a reasonable package. Now, if you're a junior miner and you have to go to streaming and royalty businesses, thank God they exist. But it isn't the cheapest money. So we asked to be in a position with them, and Caroline Donnelly and Mike Harrison at Sprott are fantastic teammates, that we can actually buy back 50% of that stream over a period of time. And they still end up with some fantastic options, because that 2% royalty they end up with a mine that could be going on for 30, 40 years, is just great business for them. I mentioned the EPA settlement agreements. Again, there's the specifics of where we are. It's really important that when partnering with, let me look at the time here, really important with the EPA. The EPA is seen by many miners as a policeman is seen by many speeding drivers, a problem on the road. But actually, we found the EPA and ourselves were completely aligned in our commitment to ensuring there was no environmental damage from a mine site that they'd cleaned up. When this mine gets restarted, it'll be the first mine in a Superfund site. That's a Superfund cleanup site, a site that the US government has funded to tidy up in the history of the Superfund program. So for them, demonstrating that they're not just a policeman stopping miners speeding, but are those that are prepared to partner to bring mining investment back into tidy up areas is absolutely critical. And we found them to be superb partners. It takes a while to build trust, like all partnership, and that needs to be earned and maintained, but we're finding them to be superb. There's our development timeline. As I said, we've started work before the PFS is formally issued. That isn't irresponsible, though the fantastic talk yesterday by the guys from Incomet talked about the balance of risk and reward when you shortcut things. This is a deliberate decision based on us leveraging existing infrastructure. And there's no point when you have to spend $2.5 million every year on water treatment wasting time. I can only issue you the PEA numbers. Our market cap today in US terms, I wish it was $40 million. It isn't. It's around about 32 to 35, sadly. I'm sure we'll get up to 40 next week. But just use the $40 million number. You can see the PEA, that which we've issued, it gives you $143 million of value. But if you put in spot prices of $175 zinc, $1 lead, and $22 silver, you can see the upside exposure to the metal price. But remember, when we do our PEA, we're not doing it over 100% of those resources. But that is all the upside that we're going to be moving towards, plus. The other point I'll mention with the very short amount of time I got available, sorry, Kai, not even going to get a question in probably, is the Bunker Hill mine is the shallowest in the whole of the Silver Valley. It's also got slightly different geology. For the geologists in here, over to the right, it's primarily tetrahedrite and galena. On our side, we've got this zinc-heavy sphalerite as well as galena. We don't have tetrahedrite. Large volumes. Just so you know, underground block caving was experimented with in Bunker Hill in 1942. It kind of worked on a low-grade part of the body, as far as we can tell, and it left behind a bit of an environmental mess. But other than that, they did a lot of shallow mining, and 165 million ounces. The bottom line for this slide is we've got all that area at depth where the higher grade silver is that we're very interested in unlocking, but don't expect that to happen until we've dewatered the mine. That could take a few years. So you're getting all of that exposure, and I know many people here are not going to be holding the stock for the time taken to get there, but getting that value into our stock is something that we're looking at very carefully. So we did some geophys near the surface, or on the surface, obviously, walked over the land, and we found ourselves a couple of interesting anomalies covered by a very small amount of top cover in areas that the old-timers with donkeys and picks wouldn't have got into. Now, we found that last year. Are we going to be able to put some drill holes into it this year? It all kind of depends on priorities and budget. If we can, we'd love to. But the size of them, by the way, and again, I've got to be careful what I say, is sufficiently exciting to be something that should they turn out, and there are geologists in the room, and they know a lot more about it than me, should they turn out that the theory or the thesis is right, could meaningfully affect our short-term resource profile, because they're within spitting distance of existing infrastructure, but just weren't found by the old guys who were mining in different directions. The joint venture, this I alluded to, and I really don't have time to go into detail, is our friend at Minewater, Joe Harrington, as I mentioned his business model, got hold of it. We've got to put $3 million into this over 4 years to secure 50% of it. And in there's, as I said, a number of interesting properties. But the reason I highlight this is if we can put some drill holes into this, you'll see the bunker story. You'll be getting value for the move to production, but you'll also be getting, should this be what we think it is, evidently we do, is you'll also start getting value from drill hole data on one of the areas. And our option value on this, effectively zero, other than the fact we've got to put money into it. ESG Vital when you're doing turnaround. You all know exactly what it is. I don't need to talk in detail about the picture, but there is one specific that you'll see bringing out, just like what Tim's been doing in Colombia. We've been looking for other businesses outside mining that can benefit the community as part of our offering to the relationship. And it's highly likely you're going to see this year us build a pyrolysis plant with a partner on site, and what that does is convert forestry waste into biochar, which locks up carbon and can be sold into a biochar market. It's like a fertilizer, basically. Forestry waste is the biggest source of fire risk in that part of America, which is a big issue. It also employs people, gives us carbon credits. None of these things I'm rattling off cynically. It's a very easy thing to do, and we're partnered with the London-based Future Forest company on this. It's things that other mining companies do, but I just want to let you know that we're doing it too. And I'm going to end with that because we've been busy and I've talked too long. Thank you very much for your time.
One last question, Richard, because you didn't mention it. When is the PFS coming out?
It'll be in June.
June, perfect. Yeah. Then we'll have the updated numbers from the PEA.
Yeah,
fantastic.
Absolutely. Yeah.
Richard, this was fantastic.
Thanks.
Thank you so much.
Thank you.
Really appreciate it.